Joining us for that is Scott Siefers. He is managing director and senior research analyst at Piper Sandler. Scott, let's just talk about the banking crisis to this point. The immediate crisis has been one where deposits were fleeing from the smaller banks. People were taking out their money and pushing them into bigger banks because they thought those were safer. Have we stemmed the losses when it comes to that at this point?
Hey, Becky, thanks for having me. I certainly hope so. We got a little bit of validation last weekend. I'm hopeful that at a minimum, we're sort of restoring a sense of calm to the system. We, as you appropriately noted, got a little resolution last week on one of the bank closures from a few weeks ago. Just as importantly, some validation that deposit outflows weren't as bad in those early days of the crisis as many had sort of feared. So, hopefully that's an indication that investors at least are feeling confident that perhaps the worst of things has passed. Ideally, that'll be the case, and some of the recent volatility will begin to subside. Realistically, however, we've just undergone a real and pretty jarring shock to the system. Healing from that shock is going to be a pretty extended process, and unfortunately, that in and of itself just means a host of new headwinds for the space more broadly. So, we still have probably half a dozen kind of longer-term landmines out there that investors are trying to navigate. Hopefully those will create a safer system so that we can prevent shocks like this from happening again. But, we're going into an arena that rewards kind of safety, liquidity strength, et cetera, at the expense of growth and profitability. Generally, that's going to have negative ramifications for the industry's return and earnings. So hopefully past the worst of it, but there's still a lot yet to come.
I'm glad you used the word healing, because I've been kind of thinking about this as the immediate crisis being a viral infection. But maybe there's a bacterial infection to follow. You talk about these other landmines that are out there. What do you see? What are the potential problems?
Yeah, excellent question. And that's actually a pretty good analogy. As I look at things, some of the roughly half dozen or so that I would think about include higher capital requirements, safer but likely less efficient balance sheets with less interest rate risk, probably less loan growth, the possibility for a credit cycle, and then I think a higher regulatory burden kind of speaks for itself. And happy to get into a little more detail on how any of those might manifest themselves.
Okay. What's it look like? I mean, if I'm an investor and I'm trying to avoid the landmines, what do I have to look out for?
You bet. So maybe we start with higher capital requirements. One of the concerns has been these unrealized losses. So now the largest banks already have to include those losses in their regulatory capital. And when I say largest, I mean, the B of A's, Citi's, JP Morgan's, Wells Fargo's. Most banks, however, do not. It seems likely that at least for a large cohort of the industry, we'll probably have to bridge that gap, which simply means more capital over time.